The question about like, would my lifestyle accrete with extra stuff? I don't think so. I mean, what I'd say is I told myself this a long time ago, which is that I would let all my financial decisions be based on my net wealth and not my income. And I've been pretty firm to that. So I don't care what my income is, I care what my net wealth is. So if my income tomorrow doubled, tripled, that would not have any impact on my lifestyle, except that it would increase my net wealth sooner, and that would have an impact on my lifestyle sooner. The Aussie Fire podcast is a collaboration between Strong Money Australia and Pearler, Australia's favourite boring long-term investing platform. Join our hosts, Dave from Strong Money Australia and Hayden from Pearler, as they discuss all things financial independence. At Aussie Fire, we're big fans of sharing experiences and talking about money. However, please note that any advice is general and does not consider your financial situation, needs, or objectives. Consider whether it's appropriate for you, and if in doubt, speak to a licensed financial advisor.
Hey everyone, welcome back to the Aussie Fire podcast. So today in this episode, we're going to be answering a bunch of really thoughtful questions that have been sent in by listeners. We love getting your questions. It's actually probably one of the favorite things for me to do, Hayden. I don't know about you, mate, but I love answering questions because it's often things that I wouldn't think to actually bring up on the podcast. So it's actually good if we get specific kind of intricately detailed questions so we can offer different thoughts on various situations. So we've actually got one about debt recycling and capital gains tax. There's also one about how to deal with risks and maybe protecting your portfolio if there was something like a war with China, let's say. We'll also be talking about using property as somewhat of a short-term strategy for leverage before pivoting to shares later. That's a common question that I get. And we'll also talk about how to think about asset ownership between partners for taxes. So we'll touch briefly on that as well. There's also one in there, mate, a special one for you, specifically for you, about lifestyle inflation and high-paid tech jobs. And we'll also talk about how to retire if most of your money is inside super, but you're wanting to be financially independent before that. How do you kind of handle that in-between period? So super interesting stuff.
Yeah, these are all great questions. Looking forward to jumping into it today, Dave. Obviously, if you like the idea of asking a question and you're listening to this podcast thinking, oh, I'd love for Dave and Hayden to chat about my question, you can just send them through to us via email at hello@aussiefirepod.com. It should be in the show notes or links or whatever the podcast notes are, wherever they are on the platform you're listening. We do sometimes edit them for simplicity, but we'll always keep it anonymous if people would like it to be anonymous. And if they don't state otherwise, we just assume it to be anonymous. But let's jump into the first question. So the first question, Dave, is about debt recycling. This person clearly has a share portfolio that isn't being debt recycled right now. And the question is, what are your thoughts on selling down a large portion of shares to pay down your mortgage in order to debt recycle? Is it worth paying the tax, the CGT tax that comes with selling out those shares in order to debt recycle? I think just for the listeners, obviously, if you're debt recycling, you need to probably sell down the funds in order to get the cash to pay off the loan, to redraw the loan, to buy the ETFs or shares in order to debt recycle. So it's a little bit of a handling effort, but you do kind of still need to do that. So
it is, yeah. So whether it's worth it is a tricky question to answer. And the reason for that is it's going to depend, because obviously you need to sell a big chunk of shares. Okay, that's fine. And you're going to need to pay capital gains tax on those shares. But the amount of capital gains tax that you're going to be up for is going to depend entirely on how much capital gains are embedded in that big parcel of shares that you're going to sell. So it might actually be not much if you've put in a lot of savings over maybe like the last 3 or 4 years and you happen to be maybe selling at a time when prices aren't super high, kind of like now as we record this, because we've had a little bit of a pullback. But if a lot of your capital that makes up that large parcel of shares is actually your savings and not capital gains on those investments over time, then the capital gains tax bill might not actually be that high. So it's going to depend on the embedded gains in your portfolio. So you'll only be able to figure that out when you look at what you paid for those shares and what you're going to be selling them for. And then you're also going to have to know how much tax you're going to be up for will be determined by your individual tax rate and who's kind of owning those shares in the portfolio, because you might be up for not much tax if you're on a lower tax rate, or a lot of tax if you're in the highest tax rate. So that's going to determine it as well. And then once you've kind of got that number, and obviously to do that, you might want to either, if you use a tracking tool like ShareSite or Navexa, they can kind of help you figure out how much gains are in the portfolio and then how much tax you might be up for. Or you can sit down with an accountant and someone who can run through some scenarios for you. And it's honestly probably worth paying for something like that, because there's such a large amount of money involved and a big potential tax consequence or tax benefit on the other side. So it's definitely worth paying a little bit of money to get the right idea for your situation there. But once you've got the tax bill or potential tax bill that you expect to have to pay, then you have to compare that with how much you might save by debt recycling, or the potential tax benefit from debt recycling. So if you have, say, a $300,000 mortgage that you're wanting to debt recycle, you're probably paying something like $18,000 a year interest on that portion of the loan. And let's say your tax bracket is like 30 to 37%. You might save something like $6,000 per year in tax by debt recycling that large chunk of the loan. So to save $6,000 a year, how much capital gains tax would you be willing to pay? Somebody might say, I'd be happy to pay $60,000 to save $6,000 a year. Someone else might not want to pay even $30,000 or $40,000. That might be just too hurtful in the short term to get that kind of longer term benefit. So it's going to be a personal choice on how much tax feels acceptable to pay to kind of get the ongoing tax benefit potentially of debt recycling. So does that make sense?
Makes sense to me. I mean, I actually don't have a lot to add on that, Dave, because it's a pretty straightforward concept. There's an upfront cost that you'll have to pay that gives you a longer term ongoing income or benefit or whatever you want to think about it. And it's really just going to come down to how much is it gained, how big is the mortgage, how long are you going to keep it before you pay it off. There's so many variables there, but it is just numbers, thankfully. You could actually write it down. You probably don't need to be, if you have some basic comforts with Excel or you come from any kind of STEM background, I bank a lot of people could dump it into a spreadsheet and figure that out pretty quickly. One thing to kind of keep in mind is, and Dave and I have talked about this previously, is like the ATO has these rules around what they call a wash sale, which is basically where you sell your assets and rebuy them slightly differently. The classic case of this is someone who might sell out their portfolio if it's down on June 30 and rebuy it on June 1, and then claim a big loss on it or something like that. This is something that you have to keep in mind if you're ever kind of selling an ETF portfolio and then rebuying it with the debt recycling. The main thing to keep in mind is you just need to be able to reasonably show that it wasn't a wash sale, and that can come from a few different ways. One obvious one is like if you have shares that you're selling out and then you're rebuying it, say, as a joint with a partner, that's a whole different thing in that sense. If you're selling them out and rebuying different things, then that's another thing. And often that's quite a common thing I find, because most people who are going through their investing journey, the ETFs they bought at the start, over a couple of years, they might realize they don't actually want to hold those anymore. So sometimes that kind of sell out event is a great opportunity to change what you're invested in because it's advantageous. So it's obviously not a wash sale too.
Yeah, that's a good point. Yeah, the way the ATO looks at it is if it's blatantly obvious that you've structured or restructured and taken certain actions in your portfolio for the sole purpose of claiming a tax benefit, then that becomes more of a gray area and a questionable area where they're like, maybe we're not going to allow this sort of a deduction. So if there's some sort of differentiation there, like Hayden said, if some time has passed or they're different assets or different holders or things like that, that's way more palatable to the ATO and things like that. So just be careful around how you're taking actions around things like that. So let's go on to the next one now, and I'll read this one out. So I'm enjoying your podcasts and articles. I'm guessing they sent this one to me. I wonder if you might do one on whether FIRE investors should take specific action to protect their assets in the event of a war with China that Australia got dragged into. Hopefully, I'm worrying needlessly about this, but it has been on my mind. What do you think, Hayden?
It's a great question. Like, I won't lie, I've thought about this too. I think the problem I have with, I think the answer I have to this is that I don't know, and I don't spend time thinking about it because it's such a nuanced, complicated thing. Wars sometimes create booms. Sometimes they create busts. Sometimes depends who they're at war with. And it's such an unknowable thing that there's no way I could plan around it because no one really knows what you're planning for. The only broad answer I'd have to any of this is make sure you have a diversified portfolio, right? Because that's the only thing that you can reliably say broad-based would protect you against it. Because obviously, like, I'm quite US heavy at the moment, which has hurt me at the moment with all this tariff stuff. No one really was thinking we'd have this problem 2 years ago. That's a choice I made. So if it worries you, just stay diversified. Otherwise, you don't know what the future is going to hold or all the nuance around it. That'd honestly be all I have to say on that one, Dave. But don't worry too much about what you can't control, because everyone will be in the same boat for these kinds of, broad scenarios. You're not going to be there being like, oh, my life's ruined and everyone else is thriving. And it's like, we're all going to be in the same boat in these horror scenarios.
It's tricky because it's also a little bit dark, like you said, because sometimes wars and any sort of conflict like that creates uncertainty. So there's initial price falls just based on the uncertainty, especially like the tariffs and things like that. But then wars also create like massive government spending typically, which ends up feeding its way back into like company earnings and then eventually asset prices. They tend to follow that. So it's a little bit dark. Wars tend to be a lot worse for human life than they are for markets. So not a nice thing to think about, but it tends to be that way if you look historically. But the question itself is interesting because the idea of protecting yourself, those are the words used, right? So I'm thinking they're not wanting to, or they're trying to avoid short-term losses. That's how I'm viewing the question as it's being framed. So the only way really to protect yourself in that way and trying to avoid a downturn over potential war and conflict is to just be less invested. But obviously we know that that's less than ideal over the long term because less invested, less risk, it's going to be less rewards down the track. So it's tricky. You're going to have to, if something that's really bothering you and you can't kind of get it out of your mind, you're going to want to simply keep less cash. Like Hayden said, have a more diversified portfolio so that you don't want maybe an Aussie only portfolio. If you're worried about Australia specifically, you want to have a global portfolio in that sort of a sense. And then you can have other assets like property or gold or something like that if you really want to have, this big mix of different assets and bonds and things. But I noticed that this type of questioning starts to happen with anyone that builds a decent sort of portfolio. You start to think, okay, I actually have some money at risk here. So your mind starts to wander like, oh, well, what if this happens? What if that happens? But I tend to not spend time thinking about these things either. So a little bit like you, Hayden, not because they don't matter and not because they couldn't have massive consequences, but because I can't reasonably predict anything about them. I can't know when they're going to happen. I can't know what their outcomes are going to be. I can't know what the best plan of attack is going to be. I simply can't know any of that beforehand, and trying to plan for every conceivable scenario is going to lead to me investing in essentially a fearful manner, and it's going to lead to a pretty suboptimal result over the long term. So I tend not to bother with it, and I try and focus on the next multiple decades rather than the next 5 years or so. So that's how I kind of frame it.
So let's jump into our next question. This person says, with the power of cheaper leverage able to assist property and your experience with it, how do you feel about using it shorter term, say 8 to 10 years, to build equity, then cash out and dump into shares? Providing that you got good capital growth, this would help your initial capital grow alongside the excess cash available, still going into the shares portfolio. Just seeking your advice on this, as from what I gathered, Dave has essentially been on this journey and invested like this. It's a great question. I do think we talked about this in a previous podcast, Dave, about, even you said that investment properties can be a great way to get hyper leverage early on And yeah, I'd be interested in your thoughts on it.
It really can. I think some people tend to see what I talk about now and try and present like a more balanced view of here's the pros of shares and here's how property works that people don't appreciate. So I try and because obviously we look at society, it's a very, very pro property, like property is incredible and shares are like this kind of mysterious, questionable, volatile asset. So I've tried to sort of balance out the public opinion and share the alternate side of both of those assets that many people I see not appreciating or not quite understanding fully. So in doing so, I think my opinions have been misinterpreted sometimes to say that you can't or you shouldn't invest in property, which is absolutely not true. You can definitely make higher returns from property because of the leverage. So this strategy can work where you take a few leveraged bets, essentially, probably ideally early on in your investing. And then if you have like an 8 to 10 year time frame, then if you want to cash out later, which you probably are going to want to cash out later so that you can reinvest into an asset that has, frankly, like a better income stream with no costs associated, and it's kind of easier, more flexible to live off with shares. So if that's the plan, it can definitely work. But the thing that people forget is it's not just pure upside with property and leverage, because people think, well, if I'm leveraged 4 to 1, I'll just get 4 times the returns. And it's absolutely not even close to that, because you've got so many things that dilute that return. So you're going to have stamp duty. Obviously, that's a big one. Buyer's agents fees. You've got ongoing negative cash flow, which right now is actually larger than normal because of where interest rates are. And then you have to deal with flat and sort of meandering markets that don't really go anywhere for a while. And then later you're going to have selling agents fees, and then you have capital gains tax at the end. So all of those dilute your return by quite a lot. And it's usually much more than people think. So whether it's going to work depends entirely on the property you purchase and the cycle that you find yourself in. So 8 years might work, but it also might not be enough time, quite frankly, because property markets can go sort of up, down, flat, nowhere for relatively extended periods. And sometimes the growth comes all at once. And that sort of happened with sort of Brisbane and Perth in the last 3 or 4 years, let's say. So that's worth keeping in mind. And I got a comment back on the property specific podcast that we did when I said about shared the lessons from my journey. And one of the comments was like, well, if you just buy good capital growth property, this doesn't happen. And so they were suggesting that I could have avoided some sort of a property downturn or got some specific asset that's just going to grow in perpetuity and get this great growth rate regardless of the market that you're in. But that doesn't work like that. That's kind of a naive comment. Yes, you can buy better than average properties, but if you're in a city that's experiencing a flat market for an extended period, or you happen to buy and then the market goes up for a little bit and then down for a bit and then flat for a bit, and you've got these holding costs and these purchasing costs, there's no way to somehow magically create excellent leverage returns when you're sitting through a market like that. So it's just not while it sounds right in theory, it's not feasible through all markets and over time. So it's going to be highly, highly specific to the cycle that you find yourself in.
That makes a lot of sense. And I say this disclaim that I'm not a property investor. So please be aware I'm somewhat of a moron with this. But I'm really dubious of people that talk a lot about, I've gotten rich off, investment properties and stuff, because a lot of those people may have just invested at a very good time. Like if you think about this for a second, let's just take Sydney, for example. Sydney's property prices doubled, I think, between about 2014 and 2024, something of that general feel. I couldn't give you an exact stat. So then you're going to get a lot of people that bought property in that period, and this is houses it's that skewed towards, and then they're going to be like, oh, you don't make a lot of money off this. And like I live like around Canterbury, Campsie in Sydney, and it's like, they're selling $3 million 4-bedroom duplex brick buildings, in this area. And it's like, there is no part of me that thinks that $3 million duplex brick building is going to go to $6 million in 10 years. That's just my view. That's just like wild. And it's like, part of that's because no one's going to buy the damn thing because it's too expensive. And then this comes back to interest rates. It's like, it's too expensive because of interest rates. And the reason house prices went crazy is because we had a long period of cheap interest rates where people started ratcheting up their household debt higher and higher and higher. and that transfer of wealth happens. So it's like, short of interest rates falling pretty dramatically and allowing people to over leverage the hell out of themselves, because a lot of people are at their limits already, I don't really see how you should look at the last 10 years as any indicator that if my friends did it for 10 years, I'm going to start it now and do it for 10 years. But I do want to stress that, again, I don't own investment properties. I don't read about this extensively 30 hours a week. So just take that as my personal opinion of what I'm doing with my money at this point.
And the tricky part is people will look at that example and then they'll just think, I mean, this is just recency bias at large. People look at the last 10 years in the city that they've lived and then be like, okay, well, if I just buy this property, then in 10 years, it's going to be worth this much. Whereas your city might be fairly lackluster for the next 10 years. That's fairly feasible as an outcome that might happen. So you can't necessarily look at that. And I find that a lot of people, even property people, get sucked into that same kind of behavior, thinking that this market is going to just outperform forever, based on X, Y, Z. And often it happens to be miraculously the market that's had the best recent performance. It always tends to work like that. So I've seen a lot of people recently saying that Melbourne will never recover and things like that. And I just think that's just like, it's just not feasible at all to think like that no market's going to be bad forever. No market's going to be good forever. It's like that with property. It's like that with shares. It's like that with everything. It just doesn't really happen like that. So back to the question. Yes, you can absolutely make a couple of, or one or two like quick leveraged bets in your investing if you've got a time period of 10 years, and it definitely may work out better than shares, but there's a chance that it may not. You can't tell. It's going to depend on a lot of different factors that are unfortunately unknowable right now as we speak about it. But it's definitely a strategy that can work. Let's just say that. But I do plan to actually write a little bit more about this year, because I think some people misconstrue my full opinions on sort of property versus shares, because I'm not all about one or all about the other. Different ones can work at different times for different reasons and in different environments. And so I'll flesh that out a bit more in writing this year, I think. So maybe stay tuned for that.
Cool. Let's move on to the next question. Is it better to own income-producing assets in the non-working partner's name to utilize their tax bracket benefits, or is it better to instead do debt recycling in a high earner's name? That's the question. Now, just to quickly unpack that for our listeners, they're basically asking, should I own, say ASX dividend producing assets with a partner who is not working because they're essentially on 0% marginal tax, so all of that coming in doesn't get taxed a lot? Or is it better to do debt recycling in the higher earner name, which obviously you do it in the higher earner's name because debt recycling only works if you have something to deduct, right? It's like you get a deduction, and it's like the higher your income is, the bigger the effect of that deduction, just like any deduction really. So a high income earner feels the benefit of debt recycling in real dollar terms better than someone with a lower income, for instance.
Yeah, it's a really interesting question. I'd actually never thought about it before I got this question. So it is quite intriguing. Initially, you might think, well, debt recycling, you're getting kind of tax back. So surely that's better than the scenario where you just don't lose tax. Like it's better to get extra because you're kind of getting tax back. But that's not necessarily true, because like in theory, right? So if you go for the debt recycling scenario in the higher earner's name, that might be better in the short term, assuming that the interest rate is higher than the dividend yield that you're getting, because that's the only way there's going to be sort of a cash flow loss to then get a tax refund on. So that might be better in the short term. But in the long term, it's a bit more difficult to say, because let's fast forward like 10 or 15 years, you've built this big portfolio, everything's gone really well, and then you and your spouse are looking to retire early. When you then go to like live on the portfolio or transition to sort of a semi-retired situation, it's not a great scenario if one person owns all the assets because you've tried to maximize tax benefits along the way. Because then you're going to have one person who's basically earning no income in sort of early retirement, and the other person's got all the assets earning all the income. That's inefficient compared to having sort of a even split, let's say, in retirement, where you're both getting some of the investment income each. So it's quite difficult to say what the best long-term outcome is going to be unless you unless you can reasonably forecast what your scenario or your situation is going to be like 10 years down the track or more, which I find is often not the case, because a lot of people one person might drop out of the workforce for a little bit, one person might be working full time, and then later they plan to scale down more and either retire or just work part time, while the other spouse might go back to work full time or part time, and they kind of swap over who's doing more work over time. So it's tricky to say. You're not going to know. So I find that most people's situations change more than they think over time, and how you feel about work itself may change, especially between you and your spouse, as you build wealth and you decide what you want to do with your life. So it's very difficult to give a sort of a optimal long-term answer unless you know all of those variables, which you can't really know, unfortunately. I don't know how you see it, mate. Do you have a simpler answer to that?
Probably not a simpler one. I mean, obviously, if you're both not working or not earning much income, then yeah, it would generally make sense to buy income producing assets just outright. If you're both working and earning high incomes, it would make sense generally to debt recycle, particularly into things that don't pay exceptionally high income. You've got this interesting situation where you have both and you're kind of like, where should I put my money? My two short answers here would be, one, maybe half is a great solution to all these kinds of predicaments, because you don't know, as Dave said, like, you might rely on those income producing assets at some time, or if you need cash in the future, you don't want to sell out those debt recycled assets because it'll incur a big tax hit because you got a tax bill because they've probably been growth assets. So, I mean, it's such like a who the hell knows the future here. My just personal view here would be, if you are in a situation where you have this high income earner and this non-working person, I'm assuming that in both of those, like in that scenario, you have a home loan that you're paying interest on. One of the benefits of debt recycling is that it is just you investing, but you'll actually get a deduction on your mortgage too. So it's actually real money back that you would otherwise have to pay. That's real money, that you get back every year. So like that's kind of the really shallow, simple answer I'd have, Dave, is like, reduce your tax because that's real money you get back. But that can't be taken in a vacuum for someone listening, because it totally depends on what you and your partner's plans are, what your family plans are. Are you going to go buy a house one day and need to liquidate that? Like there's all these little nuanced factors at play. But yeah, that would be my shallow answer in a vacuum.
Yeah, that seems like the best short-term answer, but then there's obviously long-term factors to consider.
For sure.
All right, I've got this question for you now, mate. So this person says, I just wanted to say I really enjoyed the deep dive into Hayden's finances. So we did an episode on that, and you can go back and listen to it if you're interested in that. It made me wonder, what if Hayden had taken that 200 to 300K per year job in the US that he spoke about? Would he still be crunching numbers to save money on gas, or would his lifestyle have adjusted? Fingers crossed Pearler keeps growing and he can one day cash in on that ownership stake. So I'd like to add on to this question too, because it's super interesting. So do you think that your lifestyle has inflated somewhat as Pearler as a company has become more successful? Or do you feel like you simply just operate the same as you normally would and you treat it like you're just working a normal job, and so you just save and invest and keep your lifestyle semi-frugal? Or do you think it is affecting you in some way? So I suppose there's two questions there. There's the hypothetical US scenario that you went to the US, and then the one here.
I'll tell you what's terrifying is like software engineers get paid a lot. Most of my friends earn more than me, for sure. And occasionally I'll catch up with some friends from uni, that we graduated 10 years ago, and they'll tell me what their US salary is. And I can tell you that 200 to 300K is undercooking it. And it definitely you have those moments where you're like, other life paths.
Should I get the violin?
No, you shouldn't get the violin. I'm very lucky. They're just very, very lucky. But it's a crazy industry. I'll talk about that another day. But the question about like, would my lifestyle have creeped with extra stuff? I don't think so. I mean, what I'd say is I told myself this a long time ago, which is that I would let all my financial decisions be based on my net wealth and not my income. And I've been pretty firm to that. So I don't care what my income is, I care what my net wealth is. So if my income tomorrow doubled, tripled, that would not have any impact on my lifestyle, except that it would increase my net wealth sooner, and that would have an impact on my lifestyle sooner, if that makes sense. But yeah, there's been some slight lifestyle creep for sure over the last 5 or 6 years as I've earned money and saved money. I don't think the income would matter. It would just get me there quicker. So yeah, if I went to the US, I probably would have had lifestyle creep happen a little quicker because the bank balance would go up quicker is the really short story. But look, a lot of my friends will berate me regularly for not doing enough to relax and enjoy myself and all of this kind of thing. And, I don't really care what they think. But there's lots of little things. Like I'm not going to stand on a pedestal and claim that, everything's perfect. Like I've definitely just started buying more food during the week out, like a lot more, because I'm just very, very busy. Like I work a lot and shopping and cooking and cleaning is really hard. And I set myself an $18 budget. And if I can buy lunch or dinner for $18, I'll buy it.
That's very specific, man. That's very specific.
You got to have a line, Dave. You got to have a line.
Why 18? Why is it not 20 or 15? Like,
just feels right. That's it. No, I'm not even joking. That's kind of it. 20 feels like a lot, and 19 probably feels like it's a bit of a cheat for 20. Is probably the best answer I have. But it's
interesting.
I wouldn't have done that 5 years ago. 5 years ago, it was like I would basically never eat out. If I ate out, I'd be looking for a $6 lunch. I knew where all the places in my area were to get like a burger for $6 or Vietnamese banh mi for $6 or something. So it's definitely like creeped up, just I guess less than a normal person, but it kind of has to because, life is somewhat short and everything's just a balance between ruining yourself in the present and ruining yourself in the future, right? I don't know if that was too vague an answer.
So people criticize you for not lifestyle creeping hard enough.
Oh, 100%. It happens a lot because I still have like a lot of very odd habits. Like I just refuse to catch Ubers. It just seems like a waste of money to me.
Even if they're less than $18?
Yeah, I can't do it. Like I catch Ubers for work things, but like personally, I tell people I live about an hour, I think a 2-hour walk from the city. If like the trains went down and the buses went down and I'm in the city and like the Ubers were surge charging and doing like, $50, $60, I'd just walk home. I'd spend the 2 hours walking home. It annoys me to waste money on Ubers. There's like lots of things I still don't spend money on, but there's some things that I've gotten a lot more relaxed with. Or the example I gave people is like I try and do where I can, because I we all work from home at Pearl, or I try and do where I can like a little trip to the Sunshine Coast or something and do work up there for a few days, but then it's like a lot of the trips I go to, I'll try and camp. Like I went to Uluru last year because there was some cheap Jetstar flights. I think they were $150 return, but I'd stayed in a tent. So it's this weird dichotomy too, where I don't really know how to explain it to people. Cause like flying to Uluru for 3 or 4 days is like a bit luxurious, in a sense. There's a lot of people out there who just aren't able to do that financially. But then at the same time, I worked all 3 days there, still 8 hours a day, granted flexibly, which I'm very lucky about. And I stayed in a tent the whole time because it's just not going to pay for accommodation. So it is a really hard thing to give like a nutshell answer about lifestyle creep. But yeah, 5 years ago, I wouldn't have gone to Uluru is the short answer.
And do you think that that's mostly because of your investments, or do you think that that's also driven by your sort of ownership stake in Pearler? Because obviously that's part of your net wealth as well. Or do you kind of disregard that?
No, I disregard Pearler altogether. It's such a bad idea to count that towards wealth because it's a startup. There's like, it's funny, you meet people who are like, you're a successful business owner. I'm like, there is a double-digit percentage chance that this company is worth nothing. That in 3 years, for some reason or another, we end up sending out an email to all of our customers saying, hey, we're going to have to wind down. Here's some alternative businesses. We've made some arrangements with them to transfer your shares over, or you can go anywhere you want, really. And that's not Pearler customers listening. Don't be alarmed by that. That's true for every business, just to be clear. Like your stakes or your raises, like all of them, right? It's not a Pearler specific thing. But no, I don't count that at all, Dave. And it's just not healthy, because then if it goes bad, you're just like you are hedging on wealth you didn't have. But to answer your question, it's just the bank balance and the portfolio balance. That's all it really comes down to as that goes up.
Okay, that makes sense. Thanks for diving in there, mate. Appreciate it. Appreciate the detail. So the next one is, as far as I can tell, there's legislation that prevents you from accessing your super before a certain age. That's correct. I can't access my super until I'm 55. So my question is, how does this affect the early retirement goal? What if you manage to save up enough in super to retire early, but then can't because you can't access the money for, say, another 10 to 15 years? Have you guys seen anyone find a good way around this?
That's a good question, Dave. I haven't really thought about that. To be honest with you, most of the time I kind of run into people with the opposite problem where they're so scared of super, they save up all this money outside of super, and they kind of have too much money outside of super and they get to their 50s and they're like, I need to do something with that. But besides just continuing to work and save up money, I don't think there's a lot you could do unless you wanted to. The most extreme thing you could do is figure out how to access a line of credit and live off that and then pay that back once you get access to your super. But, even for someone like myself, and I imagine many people, that's like probably a little bit scary feeling. Like I wouldn't do that, probably just suffer and work. But that's probably the only way I know around it is just get I wonder if a bank out there would ever let you loan against your super assets. I wonder if that's ever been a precedent for that. It's an interesting thought.
There might be people looking into it as we speak.
But yeah, no real short answers on that one besides just keep working or take out a line of credit, which again, I wouldn't strictly recommend, but I can't see why you wouldn't be able to do that.
So I actually notice a lot of the opposite behavior in the FIRE community where people are optimizing super hard for taxes and the tax benefits of super. And people get very excited about the tax benefits of super and it seems like a no-brainer, no questions asked. This is easily the best choice. But this question highlights the downside of that, which I found like quite obvious, but a lot of people seem to look past in the excitement over tax deductions, I suppose. So there's no real workaround, man. You need something to live off between your whatever age you want to retire at, and it's assuming this is early retirement based on the question, and whenever you can access your super in your situation. So there's no magic fix, right? You need to have personal assets as well. So that's why it tends not to be ideal to kind of go all in on super, especially if you want to retire early. And the younger you want to retire, the less it makes sense. And I know that means you miss out on tax deductions. And yes, you end up less wealthy than you could have been because you've paid more tax and you haven't been able to optimize that way. But if you have more money that's accessible to you outside super, that's more practically useful than having more money that you can't access. And so that's the way I think about it. So you can have a lot of money tied up in super, but if you're like 40 years old, it's effectively useless for the next 20 years, let's say. You're going to need to work, or you're going to need to at least be in a situation where maybe you have a paid off house. Maybe you're halfway there. Maybe you can pay off your house in the next few years somehow, and that's going to lower your expenses. So then you only need to work part-time because that can be fairly effective at reducing your work needs. But yeah, it's going to come down to having personal investments and kind of maybe reducing your expenses with getting rid of the mortgage or something like that. So you can lower your work needs to get you from the period of early retirement or semi-retirement to when you can finally access that big pool of money in super.
So our last question for today comes from one of our listeners too, of course. And it is, what is the most optimal way to reach FIRE from a clean slate? My son will be in his third year of electrical engineering next year, 2025. It's an older question. He currently has about $11,000 in IVV, the ETF, from doing odd jobs and gifts, Christmas, birthdays. He's very frugal, only spends money on going out with friends for dinner. He doesn't drink, has simple tastes, no car, has a driver's license, happy to use public transport if our second car is not available. I'm going to assume that this is the question still, he lives at home for the next 10 to 15 years, manages to save 50% of his income, assuming a working life starting in 2026, $80,000 a year income, is happy to invest in property or shares, goals to achieve $100,000 of passive income from building a portfolio over that period. I have suggested, still the question, one option could be to get an investment property and debt recycle into a share portfolio, but wanted your thoughts also.
So it's kind of almost back to that property versus shares thing. There's no real optimal way as such because you're not going to know what the returns from those asset classes are going to be over the next 10 or 15 years. I would say he is in an excellent position if he's able to save 50% or more of his income starting very soon, which I assume if he's very frugal and he's still living at home, he's probably going to be saving much more than 50% of his income, I would say, based on what you've said already. So even that goal of 100K in passive income is probably going to be way overcooking it. It's probably not going to need that much, but you can probably reassess that at a later stage. You could probably, like I said earlier, if he wanted to get into property, maybe do that at the start of the journey with maybe some small deposits or something, and then invest the rest of the money into shares. That would be a pretty reasonable sort of a balanced scenario, let's say. And I suppose more specifically, if he was kind of leaning one way or another, he could make it happen in either asset, right? It can work with both, or it can work with one or the other. Maybe get him to read about both of the options and see if he prefers one asset class over another, but try and find sort of reasonable people to listen to, not the sort of property gurus trying to sell you some shit. So you have to be a little bit careful with, marketing material and things like that, people trying to sell their services. But yeah, you could do a balance of both. I don't think that there is an optimal way to do it in this case. He definitely doesn't need property. He's already in a position where he's able to save lots of cash. So if he just wants to keep it simple, he could easily build a huge share portfolio in the next 10, 15 years based on his income and savings rate. So that's what I'd say in this scenario. Don't know, do you have anything to add to that, mate?
It's a good question. Again, echoing Dave's things, that's a great kind of scenario to be in. So, that's wonderful to hear, really happy to hear that. Probably the main comment I'd make is it's hard to know exactly. Like, I've thought a lot about property investing or owning property and debt recycling, but that's only because in the last few years, my income's gotten higher, and this is like the problem with all these things, like Dave's point about it just not really being knowable, is like the benefits of things like property and negative gearing, and whatever else do depend a little bit on your personal circumstances, and depends if you want to live in the place or not, depends if they're happy to live in it. The other thing I'd probably say is I think property, I don't really have any issues with property as investments. The only ones I've started to take issues with is when people think I'm going to go buy like a 1-bedroom apartment in a big tower in one of those like massively gentrified areas as like their investment choice. So that's the only comment I'd make about, just be a bit dubious about certain types of properties, but it's all going to go fine. Like if they're saving that kind of income and they have that personality of diligence, they are going to be fine. They're going to be fine because they're saving a lot. They're going to be fine because they're going to do well in their career. They're going to be fine because if they have that mentality at this age, they're not going to need $100,000 a year to live off in 30 years anyway, So hopefully there's an element here that's like, great job and good thing that you're raising a wonderful family and that you're looking after them, but still giving them some responsibility to do. So it's just like a lot of happy, positive things from me, and just do whatever feels right for now. And I'm sure you'll adjust that plan as it goes. I don't know anyone that's had a plan that young and then just stuck with it for 10 years, but as long as they're saving money, things will keep going in the right direction. Because a lot of people think investing is, the solution to wealth. It's like the solution to wealth is working and saving. Investing is like the catalyst to make it go faster and to sustain it long term. So, sounds like all the fundamentals are there.
Yeah, 100% agree. All right, that's it for today, guys. Hope you got something out of this Q&A episode. We do love answering your questions, so keep them coming through. Send them to hello@aussiefirepod.com. If you're enjoying the show, please leave us a 5-star review, or maybe even share it with a friend if you think that they'd get value from the show too. That would be really good. And as always, you can reach out to us on socials, either Perla or Strong Money Australia, and let us know if there's any other topics that you'd like us to discuss on the show. So thanks for tuning in, guys, and we'll catch you in the next episode.
We hope you enjoyed this episode of Aussie Fire. For more FI inspiration, head to Perla.com to browse our resources, calculators, and community insights. Perla is an authorized representative number 1281540 of Sandland Private Wealth Pty Ltd with AFSL number 337927. Knowledge is power, especially when investing. So always seek advice and/or check out the relevant disclosure document for any financial product, including the PDS and TMD before deciding. These are available from the product issuer's website. When you invest, your capital is at risk, and past performance is not a reliable indicator of future investment returns.